Hi, my name is David. I came on to give you a basic overview of UVXY, VXX, and the short vol trade and what's going on with that right now. So stay tuned and we'll get on to that right away. All right, welcome back, folks. And I'm coming on to talk with you today about UVXY, VXX, and what's known as the short vol trade. Now, this might be new to you. You might know a lot about it, but I really feel like I need to get back to basics because it seems that every time we have a volatility event where we get a spike in the VIX, which happened over the last couple weeks, like all the traffic on StockTwits disappears in this realm, and I really get the feeling that a lot of people like lose all their money every time there's a VIX spike. And so that tends to tell me that there's a need for more education in this area, and we really need to up everyone's game a little bit so that a spike in the VIX doesn't really hurt everybody who's involved in the short vol trade. Because if that's the case, then you're obviously doing it wrong. I noticed just from going on StockTwits that you'll see, as the market's in relative calm and slowly rallying, more and more people, short volatility using VXX or UVXY. And then as soon as there's a spike or some sort of action in the market, a lot of people sort of lose all their money and disappear. So obviously, people are doing it wrong. And so let's get to the heart of the problems as I see them. But first of all, I just want to talk about the concepts behind the short vol trade in UVXY and VXX, just in very basic terms. So let's start with the VIX. Okay, the VIX is a number, and it's calculated. It's called the fear gauge. It's calculated by a combination of what's called a strip of SPX puts, and I'm just going to pull up VIX and see if I can get some definition of it online. And here we go. VIX, the CBOE Volatility Index, known by its ticker symbol VIX, is a popular measure of the stock market's expectation of implied volatility by the S&P 500 Index Options, calculated and published by the Chicago Board Options Exchange. Okay, so there you go. So the VIX generally, and I've explained this before, but I'm just going to do it again really quickly. In general, fund managers buy the S&P 500 index either in one way or another, and they hold on to it, and it slowly rallies. And that's 80% of all the world's trade goes somehow through the S&P 500, the SPX. And so fund managers in general buy this, and then they hold on to it, and they make money, A, by the index going up, and B, by dividends, which are paid from the stocks in the index. When fund managers get nervous, they tend to buy puts. Puts are options that allow them to sell the index at a fixed price regardless of where the index goes. So, for example, if they buy puts, if the index were to crash, they can still sell it at a higher price. That's just sort of a general description of the way puts work. You can get technical with it, and there you can go way into technical, but that's just basically. So when fund managers and other people buy SPX puts, the VIX tends to go up, and when they're less nervous and they aren't really buying as many puts, the VIX tends to go down. Okay. Let's take a look at a chart of the VIX really quick here behind me. And so I'm going to minimize myself here and pull up a chart of the VIX. And the VIX tends to oscillate back and forth between a few different numbers. And here's a chart of the VIX for the last 3 years, and you can see it doesn't really get below. This is 856, and I believe that's the lowest it's ever been. But you can see it generally stays in this range between 10 and let's say 15 or 20. And if we were to go back in time farther, you would see other spikes, but in general, staying in this range here. Now, if the VIX was created in the late 90s, didn't really become known or followed before 2000, really. I became aware of it in the late tail end of the 1990s. And more recently, products have been developed around the VIX, the most basic one being VIX futures. Now, VIX futures try to, they sort of follow what the VIX does and predicting sort of what's going to happen a certain period of time out in the future. I have some VIX futures listed here on my watch list. And they have names like VXX18, VXZ18, VXF19, and it's basically VX plus a letter and the year of expiration. These letters are commonly used with different types of futures, whether they be SPX, gold, or any other sort of commodity futures, the naming. And the other thing we have is there's a chart which compares one future to the other, and in the VIX world, people generally go to VIXCentral.com, a website run by Eli Mintz, and they look at a chart of the futures compared with each other. And so I'm going to attempt to make that stick on this side here. And so you can't trade the VIX directly, but you can trade these futures. Now you can see the futures have a kind of a wacky relationship to one another right now, but in general, they're somewhere around 19. We've got the front month futures 1960, the way back future is 1910 right now. But you know, your average person doesn't have a futures account. They would have some sort of stock market brokerage account, and so the easiest way for the average person to trade it would be to trade an ETF or an ETP, as we would say. There's different kinds of exchange traded products. There's ETFs, ETNs, and so you can group them all together under the heading of ETPs, exchange traded products. And the most popular ones are VXX and UVXY. Now, your average pro would be much more inclined to trade the actual VIX futures and VIX options. But the average retail person would be more likely to trade VXX or UVXY. VXX is based on the VIX futures, and so is UVXY. UVXY is leveraged. It's 1.5 times leveraged, however, so that gives sort of more excitement, a little bit more movement back and forth. And when we look at, if we quickly look at a chart of one of these two products, let's pull up VXX for a second. Here's a 3-year chart. You see it going straight down. If you look at a chart of UVXY, same thing. See it going straight down. The other one is TVIX, which sort of competes with UVXY, which is a 2 times leveraged product. Thing about TVIX is it does not have options on it, so it's less interesting for a lot of people to trade. But same thing. You see these charts going straight down. And so, you know, the obvious conclusion for many people is, well, if it's going straight down, I'll just short it, and I'll make money as it continues to go down lower. And in very broad terms, that makes sense. However, there's caveats to that. One caveat is that on the way down, it can be a bumpy road. These things can spike back up. They don't go down smoothly, and it can take a lot of capital to short the actual shares of these ETNs, ETPs. most of them are hard to borrow because a lot of people have the idea to short them. Most of them require additional capital from, say, a quote-unquote normal stock to short, and most of them have the possibility of spiking way up at any time. If you look at the normal market, the SPX or the S&P 500, or the Dow or the NASDAQ, the fear of a big move for any of these is for the market to crash and them to go down very quickly. For VIX and VIX products, it's the opposite. The fear is that it's going to go up very quickly. And thus, there's a skew to the upside, A, and B, they make it difficult for you to short them because the various clearing firms and banks don't want to have the risk on that you can't cover your position, and they're left sort of holding the bag, so to speak, on losses. So not as easy as you would think to just short these things, hang out, and wait until they go down lower. Now, if we look, however, at the last couple years, things have been pretty placid for many of these products, and a lot of people have made a lot of money by shorting them. This is one chart that I like to look at a lot, which shows contango over a period of time. And this shows contango over since 2009, and anytime this light blue line is above the red line, that is when these products are experiencing positive decay due to contango. So thus, let me talk for a second about contango and why these products, UVXY and VXX, go straight down. Why do they go straight down? That's a good question. Because when we look at the VIX, well, the VIX doesn't go straight down. It just oscillates kind of between 10 and 20, something like that. But the products go straight down. So why is that? Well, the major reason for that is due to something called rebalancing in contango. And that sounds kind of complicated, but it really isn't. What it is that in general, the relationship between the futures is one where the farther out months are more expensive than the front months. So let me see if I can pull up someone else's chart so that I don't have to make one for you here. All right, so here's a chart right here. So in general, the VIX futures are in contango, which would be represented by this lower red line here, okay? Why does that interest us? Because UVXY and VIX are made up of either one or two futures. The funds will purchase futures, and then as each day goes by, to maintain a 30-day horizon, they need to sell one future from the front month and buy one future from the next month. And so each day, while we're in contango, they're selling a future for a certain price, and they're buying a more expensive one. So if we were to exaggerate this, maybe they would be selling the front one for 19 and buying the farther out one for 21. And each time they do that, they are essentially causing the fund to lose value, because if you think of the spot price as being lower than the curves here, as they purchase more expensive futures, it allows these futures to fall farther towards spot every day as we move forward through time. So essentially, you've got futures that are falling all the time towards a spot price, and every day as the fund rebalances, its composition changes, and it is composed as time goes by of more and more expensive futures that are slowly dropping in value. So if you look at VXX or UVXY, you just think your mind tends to think of it as a stock, like other stocks, like there's buyers and sellers, but it's not really. What it is it is a fund that's composed of a mix of two futures that's always changing. So you know how like they say with a person's body, your cells are always dying off or slowly dying off, and so your whole body's composition changes over time. And although you look the same, you're composed of completely different cells over a period of time. Well, same thing for this fund. And so if you think about technical analysis and what technical analysis is about, it's about kind of analyzing what happened in the past prices of a stock and using that information to try to predict the future. With a fund that's made up of an average of two futures, that composition is always changing, and so it's not going to have the same parameters as a stock at all, and thus technical analysis, where questionable for stocks, is really questionable for something like UVXY. The fact that we are constantly selling a cheaper priced future and buying a more expensive one to replace it, it doesn't cause us to lose money just based on that transaction. But what ends up happening is over time that you have these futures falling down, typically towards spot, and as they fall towards spot, as it's constantly just falling, and that falling motion is the decline of VXX. Now, if spot was always the same price as futures, they wouldn't be falling anywhere, and the VXX and UVXY would look the same as the VIX, just kind of up and down oscillating. But since the futures are higher priced typically than spot and are always falling down, that falling down motion leads to a falling down in price of VXX and UVXY. So what's the problem? Most people understand, if they study a little bit, they can understand the concept here of an ETN an ETP that's always falling, and they can understand, well, if it's always going down, I can short it, whether I'm shorting the shares or I'm using some sort of option strategy. Now, my channel has lots of option strategies on how to short this effectively, and using common sense to have some good option strategies to short this. But most people understand that if they do some studying, that if they short this, they will make money over time. If you go into the sort of StockTwits forum or other forums, you'll see it full of people who buy UVXY or VXX with the intention of catching a ride on a volatility spike. So a lot of people will come in if they feel that the market doesn't look good or the market's going lower. They'll jump in and they'll buy UVXY or VXX, and they'll look for a short-term spike where it goes up quickly, and then they can sell out what they bought and make some money. That's a very common strategy, and it works for a lot of people who are able to time it right. The people that are shorting this are using a completely different strategy, which is a longer-term one, and but both make up the market, and I'm not here to tell you which one is necessarily right or wrong. It's not really about that. I'm here to kind of educate you about what's going on here. What's the big problem that I see? The big problem that I see is that every time we get a vol spike, a lot of people are losing a lot of money. So why is that? It has to be because people are not implementing the right strategies to use to take advantage of this. And most likely, in my opinion, people are getting too big and putting too much of their total percentage into shorting this and not leaving themselves enough liquidity to survive spikes. Now, we've had two big spikes this year, so you'd think people would be learning from that these spikes do happen, can happen, will happen definitely at some point. And you know, if you're a person who's employing the strategy of buying a UVXY or a VXX and looking for it to spike higher, well, with that strategy, your parameters are a lot different. You could use a bigger percentage of your capital playing the long vol trade. This is because if these go down, they're going to decay slowly. And I'm being careful here because it depends where volatility is. But basically, when these go down, they're going to, you know, they're predicted to go down slowly over time. And but if you're long it, you could commit a little bit more capital over a short period of time, and have that be safer than going all in short for a short period of time, because to short volatility, you need to have a lot of resources on the sideline so that you can weather the up moves. Because, you know, what's the point of collecting 5% a month or something for month after month if you lose it all on one big spike? So this is a little bit of a complicated trade, and you need to think things out before you commit to it, A. And B, if you're going to trade short vol, you do need to commit to it. If you're just going to take your position off as soon as it spikes, then you're going to end up losing money, because you're going to lose money, a lot of money in the spike, and you're not going to give it time to come back, or you're forced to cover. Then it's going to be a losing proposition for you. So I think a lot of people who have put on the short vol trade, I suspect a lot of people made money last year when the markets were calm, putting on the short vol trade, and then they got blown up when we get a spike. So there's some possible ways to combat that. One way to combat that is to not put a position on until there is actually a spike, and so to sort of have no position until volatility spikes, and then initiate a position and kind of ride it back down. But the other possibility is to have a small position on that you can add to if need be when things spike, but most importantly, that has enough time to weather the storm. Now, the major advantage of actually shorting the actual underlying of these is that it doesn't have an expiration date. Now, shorting an underlying will require sometimes paying a hard-to-borrow fee, a fee to borrow the shares to short. It can also come along with buy-in risk, where you need to borrow shares to short, and sometimes those shares can get called away from you. So those are two tricky, risky things as well. So my solution basically to these risks is to use an option strategy that goes far out in time, and to keep the expiration for these option strategies far out in time, so that you can weather the storm on this trade. I mean, it was amazing coming into this last year and seeing people put on short volatility positions and make money month after month and feel like this was a easy street and this was an easy game. And but I was shocked to see in February that many people had not only committed all their capital. I mean, if they had $10,000 to their name, they'd put $10,000 either short UVXY, VXX, or long an inverse product like XIV or SVXY. They had not only committed all their capital, but they had actually borrowed money on top of that and used all their margin to be long XIV or SVXY. And that is when they got really, 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 really hurt. These products move around, and because of the leverage, you don't need to commit all your capital at all. And in fact, I would recommend leaving most of your capital on the sidelines. And I know that's a hard concept for people, because people are like, well, I've saved up X amount of money. I want to put it all to work. You know, what's the point of saving up 10 grand if I can only put 1,000 of it to work? And that is just something that you're going to need to learn to think about in a different way, because just because $9,000 of your $10,000 you have is sitting in an account to cover for a spike doesn't mean it's not quote unquote at work. It is there so that you can survive the spike. Because if we look at this charts once again, and I know it's kind of hard to look at a 3-year chart in these things because they go down so much, but let's just look at maybe a 1-year chart in UVXY. Well, let's go out. Let's see if I can customize this here for a second. 1 year, 5. How about 5 years? See what that looks like. Um, 5 years. Sorry, I need to learn how to do this off the air, but 5 years by the week. Let's try that. Okay. If you look at a 5-year chart, you can see that, yes, it always does go down. And if you can weather these spikes, you will make money. But you really need to commit to a strategy that will allow you to weather a spike of, let's say, even up to, look between that, this spike here between 15 and 16. It's almost a year. It's like a year spike. So you need to be able to weather a year, which means that your options expiry needs to go out farther than you would think. And it can be tempting to not go out so far with the options expiry because there's much more bang for the buck in the closer months to expiration. However, if we look historically, and the other thing about the VIX here is that there's not a ton of history on this one, guys. Like I said, it's been around from about 2000, but that's not that many years. That's like less than 20 years. And so there's not a ton of data for, a ton of data for backtesting. There's a couple big events that happened, but what we do know is that stuff can go against you for a while, and thus we need to move farther out in the maturity of options if we're going to short this with options, and we need to get smaller. So farther out on your options and smaller is going to allow you to stay in the game here. It's frustrating to see everybody disappear from the forum when we get an extended spike, and then new people eventually come in. That doesn't seem like a winning trade. It used to be like last year or the year before in StockTwits, you'd see a couple of people come in and try to get long these products, but the market was going straight up, and the people that tried to get long them would lose their money quickly and disappear. So there was the same people shorting this, and people, a different, a revolving door of people coming in trying to get long it. Now it's almost like the opposite has occurred. Everybody who is shorting it almost is gone, and a few people who were strategically able to get long this are still around. And but the fundamental concepts are still here, and those are not going to change. As long as we stay in contango more than we are in backwardation, this thing will continue to go lower. And there's other effects when you get a leveraged fund like TVIX or UVXY. There are other effects of due to the leverage and the way that the funds are rebalanced that are going to lead to decay on top of just that decay from contango. So you've got a lot of going for you on the short vol trade here, but it's got to be executed correctly, or you're going to find what we've found in the data, which is months of decent gains and then a big blow up, which takes away everybody's money. So there you have it. That's kind of a basic overview. I know I hit you with a lot right there, and but hopefully I can keep doing videos like this to try to, and you can pick up a little bit along the way. And I mean, there are aspects to this trade that can make you money, but like everything else in the stock market, nothing is for free here, and nothing's an easy layup. And people that tell you they know what's going to happen in the future, don't listen to. People that tell you something's easy, don't listen to. You know, you need to take money away from somebody else to make money in the stock market. And this trade, like every other trade, is not easy. So anyway, any questions, please leave them below. I've gone a long time right here. I know people get mad at me for going a long time, but this is a complicated thing. And so there you have it. Thanks for watching, and I will see you in the next one. Please leave any stuff in the comments if you have questions, and I will try to address them. I want to do more specific strategies and options soon, but I really felt like I need to go back to basics a little bit here, because we're losing people. People are blowing out. So obviously there needs to be a better job in education. I'm trying to provide some of that here. Thanks again for watching, and I will see you in the next one. I'm just queuing up a video here to put a little end music, and here we go. See you next time.